Hello and welcome to Simply Nico episode number 6. My name is Nico Giovanni Romero, but as always you can simply call me Nico. This is a vlog where I share what I'm learning as I learn it, so if at any time anything needs any further clarification, feel free to drop any comment below. If you watched episode number 5, I mentioned DTI, and if you remember the 4 C's of underwriting, today we're going to go a little deeper into capacity and explain debt to income. On that note, let's get started. What is DTI? Well, DTI stands for debt to income. And your debt to income is a ratio that takes into account your housing expense and your other debts and divides it by your gross monthly income, which yields your DTI percentage or your debt to income. Now, when broken down a little further, debt to income is broken down into 2 different DTI ratios. First one being the front end, second one being the back end. The front end will end up being the lower percentage, back end being the higher percentage. Your front end DTI is the housing expense and only takes into consideration your housing expense. Your back end DTI takes into account not only your housing expense, but all your other debts, such as your car loans, student loans, credit cards, child support, alimony, etc. An important note with debt to income is that it's gross monthly income as well as monthly installments or payments. So it's not necessarily the total amount owed on any loans or credit cards, but actually it's the monthly payments or the monthly installments that are calculated in debt to income. So how do you calculate your monthly income? Well, I'm going to show you whether you get paid annually, twice monthly, bi-weekly, weekly, or hourly. If you have an annual salary, well, you take your gross annual salary and you simply divide that by 12 months. If you get paid twice monthly, say for instance on the 1st and the 15th of every month, well, you can just take one of those payments, say the one on the 1st, multiply by 2, and now you have your monthly income. If you get paid bi-weekly, which is probably the most common, you'll multiply your bi-weekly paycheck by 26. That'll get you the amount of money you make an entire year, and then you simply divide that by 12 months. Similar to bi-weekly, if you get paid weekly, you take your weekly paycheck, multiply it by 52, which gets you the amount of money you make in a year, and then you simply divide that by 12. And lastly, if you get paid hourly, it's a little bit more complicated, but we're going to take your hourly wage and multiply it by your average number of hours worked per week. Take that number, multiply it by 52, and then simply divide that by 12. That is it for today. Thank you so much for taking the time to tune in. If it was at all helpful, please leave a review, and even better, share with a friend. Next week, we're going to be getting into adjustable rate versus fixed rate mortgages and why it's most common for people to go with a fixed rate. But until then, I hope you have an amazing week. Bye for now.